Hello, everyone, and thank you for participating. In a global survey done in 2020, 9 from 10 investment impact investors said that their portfolios were exceeding their expectations. Investments on ESG have grown more in the last 4 years than in all of a decade. This acceleration didn't come about by the great values that these investments bring to society and the environment, but also for the appealing financial returns. To lead this discussion, we called Carolina da Costa, partner for ESG solutions at Nova Capital. Thank you, Carol. Thank you, Chris. Congratulations, ABVCAP, for this wonderful event. This is a topic which grows in importance, but also in need of bringing people with know-how to help in the expansion of understanding the market, understanding the impact of this type of investment strategy and the investments that it brings to society and investors. This panel has an interesting topic. We're going to talk about returns versus sustainability. And for those who know about this topic, I guess you've heard about this so much, and sustainability and returns have been linked. But it's always good to bring you some clear cases and people with know-how and long experience in the matter, because it always hasn't been like that. So we're going to get a little bit of the history view, the historic view, and the future view. And we're going to see a few very successful exits that these three managers have been managed to undertake. And I am coordinating this conversation with three high caliber people. Daniel Pizzo, one of the founding fathers of impact investment. Actually, Vox is a pioneer in this world of impact investment. He's got a lot to talk about. He is a co-founding partner at Fox Capital since 2009, Daniel, and I think it's obvious now. When he started back then, many people didn't imagine that. People thought he might have been wrong, and today he's showing everybody that he was right all along. We also have Hannibal Adish. I never know if I pronounce your name okay. We're just Hannibal Adish. Everybody knows Hannibal, right? He's also a pioneer, a managing partner, and it is a global firm. And they're focused on climate solutions. He's got a lot to say. Hannibal is a reference in the market. And, we're going to talk about these topics which are not necessarily easily connected. ESG they're very correlated, but it's not the same thing. And then we're going to bring Mr. Pano, who also has great experience since 2003 with small and mid-sized companies, especially in the Northeast, where we see lots of opportunity. And he's responsible for the management of the VIR4 fund. And Pepe will tell us a little bit about the new fund. For us to get warmed up before we go into the cases themselves, I think they've brought very interesting documentation to illustrate. Let's do a warm-up round. Let's get your view as managers. Starting with Daniel, who's the pioneer of this topic. Daniel, tell us a little bit about how Vox Capital, how your impact investment thesis, what have been the biggest barriers, and how has Vox overcome those barriers, those challenges? Good morning. Thank you, Carol, for your introduction, for the kind words. It's a pleasure to be here. Vox is a pioneering manager. We've been operating since 2009, talking about impact investing in Brazil. And since the beginning, our philosophy was to show that we had been talking about an investment model which had no trade-offs. The biggest question, one of the main questions, we still get this question, but we used to get it a lot when we started. The question was always like, what are you going to give up in order to achieve social impact? And our perspective at that time, we still didn't have that validated, our ideas validated, and we thought that if you worked to create solutions which eventually improve people's lives, this would generate stronger companies with better brand images, brand equity, higher loyalty, higher goodwill from society with more business being done, and that would reflect into the numbers. We were sure that if you joined, if you've brought tangible impact, a tangible effect onto the core business, the main product, this, as time goes by, would help to improve your financial return because the value you're delivering to society would return, would go back. Since 2009, we've been doing venture capital. People are talking about investing in startups, Series A, Series B, especially in tech businesses to provide better access to basic services like education, health, and financial services. The choice of these sectors also take into account the logic of return versus impact, or return and impact. Why does the panel say it's return versus impact? It's not versus, it's and actually, return and sustainability. And the joining of these two things and these sectors is that on one hand, we're talking about basic sectors. Anybody who's without access to any of these core services will have a lower quality of life. And the average Brazilian does not have good access to basic services. We don't need to give you numbers or anything. Like 40% of Brazilian adults still don't have any banking account or have very little or are underserved in banking services. 50% of people don't have special health services, and when they need some kind of ambulatory service, they need to wait months. So, etc., etc., etc. These are sectors that service most of, the real Brazil doesn't have real good access to these services, but these are sectors which benefit from the fact that Brazil is one of the biggest economies in the world. It's around the 10th economy. It basically just yo-yos between 5th, 6th, 10th. We're always in the top 5, top 10. And these are very large sectors where there are mergers and acquisitions happening, where you have IPOs, where there are very active large players and even bigger private equity funds looking at those companies. These are sectors that if you have a business and it makes sense, something that grows, then you have exit ways. You have a way out. You have an exit. That's always an issue when we talk about venture capital. We've been investing in these sectors. I'm going to show you later on a few results, a few cases, but we can prove what we believed is coming true. Actually, we started in 2009. It took a little longer than we expected for the topic to become mainstream. But now that it's more mainstream, its speed has picked up so much, and it's very surprising, I would say. We can say that businesses which do not worry about social environmental impacts, be they in the chain, be they customer service, the customers facing initiatives, they're going to suffer penalties in their evaluations. We start to see a few cases of IPOs in England and a few cases in other countries as well. So now it's proven that yes, if you worry about the environment and social, that would be the best way of doing business. And that is why I insist on saying that this is not a fad. This is the way that businesses are going to be handled forward. I fully agree, Daniel. Yeah, we saw a few recent IPOs which were negatively impacted. And I say, looking at the new moral threshold that society starts to adopt, and this happens throughout history, we are punished by the bad calibration of the variables. When we look at the past, 2020 and is perfect. Hindsight is 2020. And Hannibal, I enjoyed what you said. You know, Jeff Capital Partners is a global company, so you can reconcile what you have seen globally with the actions you have seen in Brazil. And more interesting is when you actually talked about Jeff, about the company. When you founded the company, the climate topic wasn't around. I mean, this has always been a very relevant topic for us, but certainly you were a visionary when you started bringing the climate talk to business conversations. Can you tell us a little bit about that? Can you tell us about your insights offshore and onshore so that we can see JF Capitals on impact investing and the joining of that with ESG? Thank you, Carolina. I'd like to make a comment. Nobody remembers my name. Nobody can say my name, pronounce my name. I thank you, and I thank you for putting me in this panel with such knowledgeable people. We as a company we focused on impact and climate solutions. This is our topic. And I'm going to talk about a few terms that I don't agree with in terms of trade-off. We are assuming things that I don't think we have done. In JF Capital, we take advantage of global trends like the climate change to seek solutions. Solutions which will provide returns and lots of return to our investors because these are global trends. We are here in a certain way solving a problem. And what we have done is to take advantage of the new trends, be they ESG, impact investing, or climate change. We have 10 people in India. We have an office in India, in the US, and an office here in Brazil where there are 9 people. And we've done many things in Brazil. And we'll talk about a few cases. You can't think about investing in climate solutions without investing in Brazil. I'm probably one of the most optimistic Brazilian, even though I wasn't born in Brazil, I consider myself a Brazilian, and I will accept that climate change is something that we have to solve, and one way of solving it is being here in Brazil. This has to do with the culture of the company. We are optimistic because we have to accept that we have these challenges to help solve these issues. And to look out for the investor. This question of is there a trade-off or is there no trade-off? I don't think that's a good question. Our focus, having this climate change focus or the social impact focus, we can generate the best results for our investors. And we have shown this, and we can even give you a few numbers showing you that we are better or we are along the top tiers. Because we always focus, in having this focus, we generate higher returns. In terms of the company, our sectors are energy, agribusiness, and urban solutions. Those are the sectors that we work in. And I think many of you know what we are doing. and many people know what they have to do. We all know what we want to do. We want to be proud of our work and we want to give returns to our investors and we want to meet the needs of the new generation, which is thinking about solving a challenge that I want to help my kids solve, the next generation to solve. Pepe, with your regional experience in the Northeast working with small and mid cap companies, this is this is a place needing lots of investment. You have over a decade of experience in impact investment. Can you give us your Northeast perspective since you have been in the sector a long time and you also have the regional know-how in the Northeast? How have you worked your impact investment thesis? Thank you, Carolina. Thank you, everyone. ABVCAP. It's a pleasure to be with my friends Daniel, Habib. We work with alternative investments. We've been doing this over 10 years. We filed for an IPO, but actually, we started our journey in 2012, 2013 is when we really started to think, look, besides giving good returns for us, to our investors, how can we make things how can we do things? How can we help the world? The answer is not that easy. Can you do the two things together? Yeah, you can do the two things in tandem. Then we started to learn and get insights and move up the learning curve. We looked at responsible investment and we started to understand a little bit about what is ESG. And then we started a journey that was with Casio. We looked for diversities, as a services company, we wanted to diversify our portfolio. And we started to take ESG practices to the companies. And we also started to create other products, providing credit. We set up a renewable energy product. We did it together with the Brazilian Development Bank. And specifically in private equity, we had already done in 2003 our previous home, which was Pactual. We created the first fund to invest in mid-cap companies in the Northeast. We set up the first office there for an investment bank, and that was really great. And we started to see, and after 2017, we took this strategy. And we as executives, seeing 95% of the decisions that we would make had to do with environmental issues. And at that time, we didn't think there were trade-offs, very one-off cases. And then we started to focus on medium-sized companies. And then we went back to the Northeast, focused on a few funds. We set up an office there. And then we took another step. And we started more of an ESG strategy, much more so than impact. Impact. The companies we invested in had social topics, had environmental topics, and we saw a huge impact. And we started to do this with all these different companies. And we decided to structure a new fund. Then we decided to take a step ahead. I understand that the focus is on returns, but we also defined that we decided that we would have 4 funds. I thought it was important. We've been talking about greenwashing, ESG washing, and of course we've heard about this already, but we don't need to promise things we're not going to deliver. Let's promise things to make more money. Let's be clear. So, what is this impact for us in this fund? Well, what we need to do is to be good at what we propose to do. And after we go through an inclusion list for each person in our portfolio, the lesser developed ones, and not necessarily startups, companies which have already been founded in terms of capital, working together with entrepreneurs, and afterwards you'll see a few numbers. And together we built a business plan, an impact plan, just like we did a business plan. But it could also be a company in Rio, Sao Paulo that would have in its business some kind of impact, of huge impact, a social impact or an environmental impact. And that's how we started to work. People really like this combination. And we had companies that were founded from scratch to solve a problem. This wasn't the case of the companies we work with. Normally, our companies have already been founded. To leave the mandate clear, the objective is clear. And we've been developing, learning. We've been learning a lot in investment processes, in our measurement. They put in board impact, many new things, many new terms that we are looking at in order to provide a very interesting return. Lots of things to learn and lots of mistakes to be made, certainly. And just an additional comment in terms of trade off, a classical investor question is, well, whatever, what about the time when we are going to reap the benefits, when we're going to harvest? We're looking at good companies. And companies which basically under other criteria would do really well, we actually don't get involved in those companies because we don't see an impact, we don't see an ESG impact. If 4 and 5 years we can't find 10, 12 companies, it's not because none exist, it's because we're doing horrible work in trying to find these companies. I think we can find 500, 1,000 companies. 10, 12 only? Of course we have 10 or 12 in Brazil at least. And so that trade-off exists. We have mapped it. Today, 25-30% is our pipeline. We basically just throw out 25% of our leads from the pipeline because many don't connect with us. Many are not a match. But there are many who are a match and who deserve higher scrutiny in more conversations. And it's interesting. We had a fund of 1 billion reals. 30% is offshore capital, and basically all the main companies are investing. BNDES, which anchors the fund, Northeast Bank, which has been helping us since our first fund. We have the United Nations. United Nations also provides us important support. We also service the customers, so we have 3,500 personal investors, families, multifamily offices, and more or less 15% by other institutions. It's well diversified, and they like this combination in this format. Everybody's in total agreement that the topic of this panel is return with impact and sustainability. I think everybody's curious to see some real life cases. And for this next round, I'd like to bring our panelists to show their successful exits. I wouldn't want you to limit yourselves to just the cases which you have shown. It's important to have an understanding, to provide understanding to the audience as far as the valuation of the portfolio under management. And we know that in the last 4 years, that valuation curve, that impact investment curve has behaved much differently than it was 10 years ago. Therefore, I'm going to invite you to talk about the cases, and an exit strategy is a profit building strategy. But if you could look at it from the standpoint of your own portfolio and your own expectations for the future. Hannibal, I'm going to begin with you. I'm going to ask that everybody look at the time. We're going to have 10 minutes for each one of you. And Hannibal's, I think you have something to present. Feel free. Can you see it? Yes. This is going to be quick. We have a proprietary methodology which incorporates various pieces of data. And it incorporates various frameworks to analyze the opportunities. Once we identify a potential return, it has to go through a fit index, and this fit index has to show. During the due diligence, we raise this number. This fit index, or this match score, or this suitability score, is this show that the company is viable? At the end, what we do is we create a dashboard. A proprietary dashboard. We create that dashboard and we use it as a debate in our investment committee. We have the initial dashboard, and then during the due diligence we will fine tune and see if we take on the opportunity or not, looking at our fit index and also other data. We call this the shared value approach. Once we are sure that we will attain those returns, we want to be able to measure those returns as well as the impact. And we measure just like we measure the return, we also measure the marginal gains. That's what we call shared value. I don't want you to get angry with me, but the company is AGV. AGV was an investment. We invested in the company in May of 2016. And we analyzed the company looking at the micro, the macro, the political, and we invested at that time with other peers. I had a friend who brought me the opportunity, and then we studied that opportunity. And AGV is a company working with health supply chain. They've got top market share in animal health, and they are among the top 3 in human health. And when we entered the company, we did various projects. We hired an advisory. And this advisory helped in the spin-off of the company called Porch, and they helped us to implement various lean processes and helped us to overcome various operating deficiency gaps, helping us to work the logistic. And this was work that we started that took about 2-3 years. After implementing everything, we have to hire people, and we'll have another unit dedicated to health. And then we had a complete spin-off of that division of AGV. We created two companies, one 100% dedicated to health and the other one dedicated to ESG. And then we divided them. We think we were able to capture more synergy there. And then we created a committee which gets together. And this committee is used to discuss policies and to ensure that the policies are being abided by. People testing helmets or the hats, hard hats, doing sampling, checking the transportation grid. This company is well aligned. Is well aligned with health. But the company also helps to reduce CO2. I think I spoke too much, Carolina, but I would say that we went into May of 2016, and 2 years later, we started the exit in 2019. Everything by the book through a private equity. We grew EBITDA 60-70%. And this helped us to get a good multiple expansion, and it allowed us to create all these processes. I don't know how much was captured in the multiple, but the buyer was one of many groups, a Mexican firm. We were selling each unit separately. And the Mexican group, which is now a great friend, and they have a logistic arms, they ended up buying the company. And the internal rate of return was 40% for all investors. And so, I mean, you'll have your friends in the good adventures, and you know, we've basically, highlighted all ESG, and now we can show that we can manage the risk during the exit. We have strategic pillars which support the value of the company. When we bought it at single digits, and we sold it a bit above double digits. And so we're very proud of that case, and I'm very proud of my friends who took part in this adventure. I hope they're not listening, the AGV guys. Excellent, Hannibal. I'd like to pass the word to Pepe to present the AFC environmental case. They work with recycling, circular economy. This is a very interesting case. Pepe? Thank you, Carolina. Let me try to measure the time just so you understand. This was an investment inside the 3 fund, a fund that is focused on the Northeast. And AGC was the last exit. We started to invest in the end of 2017. We finalized the We finalized the deal, we exited the deal in May of 2020. The fund generally had a. This wasn't a fund focused on impact. This was a fund which had this impact. Fund 3 had that ESG component due to the type of investments in the region being 100% focused in the Northeast. This is a fund set up with an internal rate of return of 28%. It's interesting that the average price in the Northeast, it's very little time. In 1-2 years time, we sold 2-3 companies and we returned 60% of the capital invested to investors. We still have 3 companies in the portfolio. You have a middle-sized company, people who are very focused, and they were focusing on recycling waste for private clients. They worked a lot with recycling, bringing technology, and they wanted capital to grow regionally to provide better technology. In the world and the sector in general, they weren't very professional. They had lots of companies doing transportation without good logistics management, without recycling. And when we put this together with our entrepreneur and we showed them what was happening in Europe, the US, especially from the perspective of bringing technology to recycling, that's amazing. That's a game changer. Especially in the Northeast, where people are more socially excluded. And we had a long negotiation. We invested again in the 24th of March of 2021. Well, the pandemic comes and we had just investment. We had just invested. We made an interesting investment because this was a debt with a kicker, and there was one share that gave me the full governance and control. Why was this investment done this way? Because we were worried about the exit. Who are we going to sell this business to? When everybody's already working with recycling, with services, and in Brazil we have very few cases, very few successful cases of foreigners coming to Brazil, and we haven't seen any Brazilian companies able to buy an offshore company. We invested, then the pandemic came, but it helped us because we used to service more than 300 clients in many segments. On average, we were able to grow. The revenue during 2020 grew over 40%. Our EBITDA grew fourfold. We made 2 acquisitions in 2 months. We bought a tiny company, 2 tiny companies in Rio Grande do Sul state, which helped in our growth. And 6 months after, then we saw Ambipar company looking for us because they were trying to grow in the Northeast and they needed help. We have an interest in continuing, but in the negotiation, Ambipar wanted control, and we have a governance where it's not interesting for us. So Ambipar injects money, they buy 60%, and the entrepreneurs continue running the business. The entrepreneurs have satisfaction. They are Ambipar people who run this business. They still have 40% of the company. They have an option to exit ahead. It had high debt. It was like 1.7 the capital invested in 10 months. Over 75% of return was gotten. Following our return principles, if the market is a quality market and the product is good and the entrepreneur entrepreneurs are good, we need a good market with resiliency, with good exit options. In this entire ESG agenda, which had been evolving, that was on the business plan. We've brought more improvements, more governance, and it helped Ambipar, who is in this business, who wants a strong ESG agenda. But they're a small player in the Northeast, but they are now going to grow in the region. And with the management team, we decided to invest in this company. So that was the story of that company, of our exit. And that's an important story showing the diversity of the types of investment, including a debt model with an equity kicker, which shows that there is a wide landscape of possible investment options in this market. Well, debt. When you work with debt, then you're worried about exiting. And that was the fastest exit in all of our history. And we had to think that way because this is a segment which is still extremely fragmented. And we had to invest heavily in the infrastructure, but it worked out really well. Daniel, I left you last for you to talk about 10, and then perhaps we're getting close to the closing of this panel. Can you give us a future perspective of your portfolio, where it's going, what you have seen as a trend, please? Here's the 10 case from Fox Capital. This case starts in 2015. We exited in 2017, so we had the company about 3 years. I don't want to give you details on this slide, just not to give you detail on how we do our investment analysis, but I wanted to show you that for us, the impact goes from the investment thesis, starts from the investment thesis. When we look at the business unit, where we can see that the companies in portfolio 2 have an impact, when basically we look at the companies that became kind of interesting. There's a case here. This is a case in the health fund called DS3. Once we identified the company which might be helping in some aspect of this business unit, we and the entrepreneurs create a change plan for these companies, and this will allow us to make the decision or not to make an investment. Besides all of the analysis, we're looking at a startup with scale up capacity, an entrepreneurial team, size of market, innovation. We also look at the impact and how that impact will be brought to the lower income population to bring access to quality products and services to socially excluded populations. So it fits. Ting is a company. Ting has grown a lot even after our exit. They provide a prepaid card which provides discount to health services. When 10 started, they had access to exams and doctor consultations and pharmacy discounts. And it was very interesting. They were very intelligent in what they did. They've set up agreements with doctors and labs as if they were a health plan. So they would knock on the door of these offices, hospitals, labs, and they would make agreements like a health plan would make. But instead of charging a subscription, TIN created a prepaid card that they would give to the families. And the families, when they would use the card, they would use that prepaid card to pay. And they would pay the price. They would pay a price similar to a health plan price. That means that in exams, you can get up to 80% savings off the list price. This compared to private services, but in terms of public health services, our public health is not bad, but we have huge challenges. Huge challenges when you offer second level support when you need a specialist. So many times there are cases like here, Getulio needed a physical therapist. He needed more specialized care, and he waited 3 months on the free health care queue, and he waited 3 months to be seen. So when you can get cheaper access, easier access, quicker access to a private service, you will be able to help people who normally wouldn't have access to such health services or quality health services. We saw that opportunity. Our thesis is to provide quality health access or to strengthen the existing private offers. Let me show you the data. Less than 20% of the Brazilian population has access to health plans or has the ability to pay for a private health plan. And this was a solution that made a lot of sense to Brazil. As time went by in our work with them in 2017, in our exit, they had 135 prepaid cards active, 135,000 families using it. Therefore, the card would charge a subscription. I think it was $24.50 monthly fee, which you could use for a family of up to 5 people. You had 135 active cards, 15,000 units. When we say units, we mean health clinics, doctor office, labs throughout the Brazilian territory. And the people who used the card would get savings up to 450 reals per year in medical costs. When we're talking about Rio, Brazil, the C economic class in Brazil, this is data. Sometimes we don't calculate this, but the C class earns about 3,500 to 4,000 per month. Class A earns over 6,500. You know, people who earn 6,500 are Class A. Only 6% of families earn over 6,500 reals. We're talking about people that for everything to eat, in terms of health, in terms of education, in terms of transportation, in terms of fun, they earn 30, 35, 40 reals per day. So when you tell them they're going to save 50 reals per month, that's very significant for these lower income residents. And we found that very interesting. What we thought was missing, what we wanted was to provide a solution that would be able to be an alternative, a full service alternative to a health plan. But we didn't have hospitals in our plan, and that's important for a health plan to offer. So the move was very interesting because we started to look for alternatives to provide them hospital services so that we can replace a health plan 100%. We used to play around that we would work with the classes A from Z. I would love to change my plan to a company that has this kind of freedom. When we went after this service, we noticed an insurance company, Generali, and they offered the improvement in the plan, but they also ended up taking the company along. They thought the offer was so interesting and it added so much value. And they said, yes, we can help you, but we want a higher stake. And then we exited at the time. We basically called, and this was the first case of an exit of an impact investment, which was successful here in Brazil. This was done in 2017. We had an IRR of 30 something percent. It was almost 2 times the initial amount invested. And we call it successful not only because we have an internal rate of return, but also because we're able to maintain and improve the impact of the service after our exit. So the entry of Generali, and this is another very common question when we talk about impact. What about the exit? How can you guarantee impact after the exit? Well, it is a fact, and it depends. It depends on how you exit. In this case, Generali maintained the previous services, and it also added that extra hospital component, which improved the services. So we have partnerships with lots of companies. They started doing like co-branded cards, like a co-branded Uber card for retailers, for different types of clients, and they had been expanding these partnerships and the people who accept these cards. In terms of Vox, when we talk about success, we don't really just look at the IRR. We have to make our investors happy so that they come back, but also the maintenance of those services, the legacy that those services leave in the country. This is another example of the Fund 1. Magna Med is a company that we still have in our portfolio, but they are the biggest producer of a product related to lung capacity in Brazil. And Magna Med serviced 80% of the respirators, and they provided these respirators to the public sectors and the private sector. Demand is still extremely high, just to let you know. But the fact is that the countries that didn't have a local respirator supplier, they basically were at the end of the line. So in the case of Magna Med, they basically confiscated the production. Magna Med could not sell the respirators to other countries prior to caring for the Brazilian market. Regardless of the IRR at Magna Med, we've paid off the principal, Magna Med principal, with room to spare. And if there was no Magna Med, and if there wasn't a Series B investment in 2015, maybe we would be in a worse situation in this pandemic. Now in 2016, we started Fund 2. It was halfway through its life. Fund 2 will present an internal rate of return of 72.5 per year. That is net. When we compare to a few benchmarks, it's 55% in dollars. So it puts us into the top 10 venture capitals in the world. In 2017 when we started our investments. And this is thanks to 3 companies. One is an education company, one is a financial services company, and the other one, well, 2 companies provide services companies and one provides education, which have been growing 2-3 times per year. And now the fund starts to go into the liquidity window. We're going to be able to talk about other exits. But what I wanted to show more than anything else is that we start to see that businesses which are using technology to service Brazil for real, in fact, in the case of education and health, we have clients in over 5,000 cities, basically all of Brazil. In terms of fintech, we have agents who allow people to pay their bills and charge their cell phone in over 2,000 cities, and when there's a banking branch and a ATM, then we service 800 cities. So servicing Brazil with technology, with basic services, will provide returns, and we start to prove that. And we started to prove that with Fund 2, but we have done this also with Fund 1. We've been able to prove this thesis with Fund 1. That's very important, for us to get to our closing. I think that what this panel said consistently is that the opportunity lies. Pepe said that the trade-off is in what you choose, in your deep understanding of Brazil, joining the opportunities. We know that the crisis will weaken the funds of the population, and it'll weaken education, waste management, like you said. The importance of this clear mandate is clear, not only from the business standpoint, but also in terms of KPIs, long-term KPIs. We can't just say that you have to measure it. We have to show what it is. And I think that the case showed a clear demonstration of the possibilities which exist in this investment arena. These investments focusing on solving these gaps. I see the people from ABVCAP asking me to, be right on time, but just for us to give the last word to Pepe, Hannibal, can you tell us in 30 seconds each, can you just give us your final comments? And I would like to thank you, everyone, Daniel, Pepe, Hannibal, for the great insights. I thank you, and my message is optimism, because we have seen returns and we will see returns in the future. Thank you, Pepe. Thank you, Daniel, and thank you, Carolina. And thank you, Carolina, even though you don't know how to pronounce my name. He's joking around. Thank you, Carolina, ABV Capital. It's a pleasure. And I see a few more friends in our next panel. The main message for everyone is that this is a journey, this is a process, and we're still learning what it is, what it isn't. You just have to be clear and consistent, and you have to be consistent in your deliverables. And obviously, we'll make mistakes, and we are all learning, but there's lots to do. Daniel, your final remarks. That's it. Thank you. And I always play around. I would like to say, this is not a fad. This is a trend. And if we look forward, investing without worrying about impact on your investments will be so outdated as throwing garbage out, smoking inside a plane. It's old school. The things are not going to be done the old way anymore. We need to do things the new way because the world needs this and because the returns will be better and better. That's it, guys. Thank you for your time. And once again, Hannibal, I just don't know how to pronounce your name. I know your name. Pepe, Daniel, it was a pleasure to be here. I learned quite a lot. Thank you. Thank you, Carol. Thank you, Daniel, Pepe, Hannibal. I'm at your disposal. We also thank everyone who has been here with us. We're going to take a 5-minute break and we'll be back at 20 after with our last session, which will talk about how to differentiate ESG investments from impact investments. We'll be right back. See you soon.